Hello there, you're tuning into the Wild Bat podcast. This is episode 6, and this is module 4, active business income. Let's get straight into it. A corporation, a CCPC, can receive 3 types of income. That being active business income, personal services business income, specified investment income, and also there are other types of income such as specified partnership income and corporate income, but we'll just discuss these 3 in detail and then cover examples of partnership and corporate income. Let's look at active business income first. The definition in section 125 part 7 is that active business income is a net income that is received by any means other than specified investment income or personal services business income. So it's one of these definitions which states this is what it is, except it's not these 2 items. It's a very broad definition, and before going into details of what the other ones are, we want to try and define active business income because this is the one that allows for the small business deduction. The other 2 do not. Personal service business income is generally derived under the scenario of the following. A corporation wants to hire someone. Rather than hiring a real person in which they have to make payroll deductions and CCPC and EI and employee benefits, they can avoid this by asking the person who they're going to employ to start a company, and they will hire the company. It also not in a taxable, not having a tax impact, but it'll also create the concept where the person is defined as a contractor and not an employee, and will not have any of the benefits that come under an employee relationship, which vary from you not being easily, like you can dismiss a contractor, you can't necessarily dismiss an employee that simply. If the contractor does something wrong, the contractor is seen to be doing it under their capacity in their company, where an employee is determined to be an agent of the employer. So creating this scenario has its benefits. However, and this is kind of one of the not a very fair scenario regarding if you get put into a situation, the employed corporation, not the employer corporation, but the employed corporation may meet the test of having personal service business income. This is defined under section 125 part 7. If you see my slide, I'll go into a bit more detail here. If the person that is employed by the corporation performs duties on behalf of the corporation, and it would have occurred under the employer corporation, except for the existence of the corporation that the employee owns. Now, this may be defined in that definition unless the employee corporation, the lower corporation, employs more than 5 employees per year, or the amount that is paid or payable in the corporation for the year is received or receivable by the corporation by which it was associated. Note that if we do go under the concept of the personal services business definition, there are severe tax consequences. The severe tax consequences are no small business deduction and also an extra 5% tax. So we've got our base rate, no SPD, also no general rate deduction, and 5%. So base rate of 38 plus 5%, you're looking at 43%. Plus provincial taxes, which can also mount up. The expenses of any remuneration to that incorporated employee, benefits, costs of selling and negotiating a contract of this of any property that was put into this company for that purpose of the relationship, negotiating a contract, legal costs of collecting the money, they're not deductible. So the full amount that the incorporated employee, the employee corporation will have to be taxed at the full rate of what they would have received and get no deduction. So in order to avoid this scenario, you want to make sure that you have contracts set up in place in order to make sure you look like that you are a contractor and not an employee. Maintain your independence. Let's look at scenarios like, if you are in a scenario, you must exert the right to control how you work, what hours you choose, and how the work is conducted. Expenses and purchases of materials, tools and stuff like that have to be purchased by the contractor or employee corporation, which you wouldn't call it that, you would call it a contractor corporation, unless you want to define it as a personal services business. Alrighty, let's move on to specified investment business. Sometimes when you start a corporation, you may want to just fill the corporation up with investments, whether that be shares and bonds, real estate in which you will rent out, and it will derive investment income. This is also not eligible for the small business deduction. Where the curveball could come in is where you say that the corporation's core purpose is not that of an investment, but rather that of another nature. Let me give you a scenario. Just say you have a corporation, you buy some property. The property, even though may derive rental investment income, the main purpose of the corporation is simply to purchase the property, renovate the property, and then sell it for a capital gain. That may be enough to avoid the definition of a specified investment business income. And that's what what the aim is right here. We're going to get more into aggregate investment income in the future, module 6. Because if it is defined as specified investment income, it will be taxed at aggregate investment income rules, which is a little bit different. In order to avoid this, the main objective is to make sure it's not investment income or employ more than 5 employees. Partnerships. Partnership income can be complicated, but let's have a go at this. A CCPC can be a member of a partnership. It could also be associated to a partnership by the way the person who owns the corporation is also in a partnership, and the corporation derives revenue from the partnership. We'll explain this in the following diagram. If this is a scenario, the income from the partnership will only be eligible for the small business deduction on the lesser of the partnership's active business income or notional partnership business limit of $500,000. Another thing to note with partnerships and CCPCs, if the CCPC has is the member of multiple partnerships, and some of these partnerships are retaining a loss, these losses can be applied against other partnership income streams to reduce overall partnership income. All right, let's slide over to our iDepot scanner where I'm going to show a diagram. Alrighty, so we're going to look at how a partnership could be defined to duplicate the SPD and kind of divert income. Alright, so we're going to start off with basic partnership of W and H. They both own a corporation each, W Co and H Co. Now there is a partnership that exists. So remember these symbols here. Circle is for individual person, square is for corporation, and this infinity symbol here is going to be for partnerships, which could consist of both corporations or real persons. So in the first scenario, we're going to have 50-50 partnership between the individuals. But then, so now this is the basic structure. So what happens is they get $2 million worth of income, net income. And now they got to divert it. So they're going to kick it up to the partnership. The partnership is then going to experience a management fee each of the corporations of $800,000. And then the corporations themselves are going to kick up a salary to the people. Sorry, no. The partnership's going to kick up a salary to the individuals of $200,000 each. Alrighty, so this leaves the partnership with $400,000 being $2 million minus $800,000 minus the other $800,000. The $400,000 worth of salary. I guess these are partnership distributions. Alrighty, so let's look at what will happen with the basic assumptions. First assumption, the individuals, they are taxed at a average tax rate of 40%. The corporations are going to be taxed under the small business deduction net 14%, otherwise it's going to be 28%. So, the corporations, get out my trusty calculator, are going to be taxed at $500,000 small business deduction right here. $500,000 times 14% equals $70,000. The remainder $800,000 is going to be taxed at 28%. And that gives us a total of, quick math, $154,000 that each corporation is going to have to pay. The individuals themselves being taxed at 40%. $80,000 taxes. So the whole endeavor right here is going to be taxed at 80,000 times 2 plus 140,000 times 2. So individual taxes times 2 and corporate taxes, because these are both the same scenario, times 2, which gives us total tax to pay of $468,000. Now I know what you're thinking, that's a lot of money. Well, fasten your seatbelts, I guess, because we have the next scenario in which we're going to change things up a little. So, same scenario here. Now, except this time, the corporations are going to be the partners. So $2 million gets kicked in, and they get a $1 million each. Now these corporations kick up $200,000 of salaries to the individuals. Alrighty, so far so good. So what happens here? Well, the corporations will have a net income of $800,000 because you've got to deduct the salary. The partnership, they've kicked up all of their distributions. Because of the anti-avoidance provision, in which we're going to have to, because of the anti-avoidance provision, which I'll just go back and have a look, the income eligible will be the lesser of the partnership's ABI or the notional business limit of the partnership. So remember that the notional business limit of the partnership is going to only have $500,000, which it has to distribute. So these corporations only get a $250,000 small business deduction. That does not sound very fun at all, does it? Let's look at the tax scenario. So we've got right here, we're not going to have $70,000. We're going to have only $250,000 taxed at 14%. And this is just for one partnership here. The remainder, $550,000, is going to have to be taxed at this 28%. Yikes. $189,000 tax total to pay per corporation. The corporate tax is going to be exactly the same of $80K. So $189,000 times 2 corporations plus $80,000 times 2 people give us $538,000. Now, that obviously you're going to be thinking, well, screw that. I'm just going to have this this scenario right here because obviously there's a better tax advantage, but there is to avoid this type of tax planning, there have been specified partnership income rules in which the CCPC may meet the definition of being a member of the partnership. So it will be just as if down here, it will just be in this scenario right here where it won't really matter because, as you can see here, the partnership is not exactly being it's not actually in an arm's length transaction. It has no real like benefit of engaging in these transactions, only for the benefit of the individuals. So it doesn't really matter right here if it's these guys here or these guys here. It's going to be the same scenario right here, which we're gonna change it up. So we're going to go back to that same scenario here. Obviously, you don't want this to happen. You want to make sure you do divert some income to the corporations, but it's going to be no kick up from the corporation, but a kick up through the partnership as a distribution, and go back to our $600,000 each. Sorry, $800,000 each. And ignore that stuff there. So yeah, it's going to be the same scenario, really, this exact same calculation, because it's going to be 250,000 times 0.14, 35,000, 800,000 minus 250, 550 times 154,000 of non-SPD income tax rate. So as you can see here, it doesn't really matter. They have incorporated an anti-avoidance provision, so the benefits of creating an elaborate scheme have been avoided. Okay, let's look at specified corporate income. So as you can see from our prior diagrams, you can set up the structure possibly to duplicate the small business deduction. But as you can see, due to the exemption, the anti-avoidance exemption, it doesn't really work out in the end. The same scenario occurs if you try and do a corporate structure. If you split out a company, which is and split out the operations, as you can see here, you split out the profit. This pi signal, you're going to see this often for profit. If you split this out with blood related, if you don't know what that means, go back to module 3 in my prior episode. Under anti-avoidance provision 256, part 2.1, if this is defined as a non-arm's length transaction between one corporation and another corporation that has been diverted revenue via a management fee or a kind of a service fee of some kind, then the result of which means that income may not be eligible for the small business deduction if it is defined. And this is just a provision, a general anti-avoidance provision that had come out after the budget of 2017. They do not apply if mostly all or substantially all, being over 90% of the revenue that the second corporation has is from arm's length transactions. All right, that's all for now. Please join me for Module 5 in the next episode, in which we're going to be talking about passive income. Thank you.